Okay, so we're going to talk about what happens when we got a couple different scenarios here. The first one is a parent subsidiary group. So I think we're probably all familiar with the term subsidiary. We're talking about when one corporation owns another corporation, right? So they own, it's not owned by other shareholders, but it's owned actually by the corporation, Corporation A. This is a parent subsidiary group. If there is a common parent that owns either directly or indirectly, and by indirectly I mean Corporation A owns Corporation B, and then Corporation B owns Corporation C, then Corporation A owns Corporation C, right? Because that's an indirect ownership, but by virtue of owning Corporation B, they also own Corporation C. If that is the case, they own at least 80% of one or more other corporations, then they can file what's called a consolidated tax return. So essentially what they do is they put all of the income and expenses onto one tax return. There's a special form for it. They put all the income and expenses on one tax return, and then they extract out any of the portion of the company that they don't own. Because if they own 85%, then obviously 15% they don't own, right? So, what's this at? Take a look at what that looks like. And the benefits of that. Why would we want to do that? Other than it saves us filing 2 tax returns, which is a benefit in and of itself. But so if we've got Corp A, Corp B, Corp C, and just for the sake of argument, we're going to say that Corp A owns 100% of this corporation, and Corp B owns 100% of this corporation. Which means Corp A owns 100% of Corp C as well, just by virtue of the fact that they own 100% of Corp B and Corp B owns them. So if we've got income and expenses, so taxable income, for Corp A, let's say their income was $1 million. Their expenses were $500,000. So their taxable income is $500,000. And then we got Corp B over here that had $2 million of income, but they had big expenses of $2.5 million. So, essentially generated a $500,000 NOL. Right, we talked about NOLs already, right? Yeah. And then we got Corp C over here. It's just a little guy. Had $100,000 of income and let's say $100,000, we'll make it easy, of expenses, so they've got 0. If each of these companies filed their own tax return, we would have 21%, sorry. Tax rate here, 21%, so what do we have? Is that 10? 105? Do I have that right?
105.
Yeah. Here's our tax of 105. We have 0 tax here, but we've got this NOL. So we can apply it to previous years, or we can go forward with it. We can use it to offset, but maybe we've had losses the whole time. We can't even use it. And here we've got 0 tax because we've got 0 income. Well, we're paying $105,000 in tax. with these three entities. Instead of filing separately, however, what if we combine them all? Oh, look at that, that's terrible. Wow. If we combine them all, 500,000 minus 500,000 plus 0 is 0. Our tax is now 0. With a parent subsidiary group, if we qualify for it, we can combine those groups together. So the expenses from one entity can help offset the income of another entity. So there can be some definite tax advantages to having a parent subsidiary group. But this is a case where they've got to own, directly or indirectly, at least 80% of one or more corporations. Like I said, they file then a consolidated tax return. File one, and then they've got to attach this form 1122 to indicate that they are consolidating this tax return. Okay. There are a couple of potential disadvantages. It is binding on all future tax years, so once you do it once, you've got to do it forever. Losses on intercompany sales cannot be immediately recognized. So if the companies are doing business with each other, they can't, and there are any losses on those transactions, they can't record them currently. Any elections made by the parent are then binding on all subsidiaries. So if the parent company decides they want to do something a particular way, all of the subsidiaries have to do it that way as well. Okay, 80% is the magic number here. So here, that one's an easy one. Garcia Corporation owns 95% of Iona. Iona owns 85% of Jasper. The entire chain of corporations is part of a parent subsidiary group. They can file a consolidated return. Obviously, they're not going to claim 5% of Iona's company's income and expenses or 15% of Jasper corporations. Questions about that? I don't know what is going on here. I thought this problem was solved. So that's a parent subsidiary. We have another group of uh-oh. There's no towel. The other classification of kind of shared corporations are brother sister. Oh my gosh. I will not miss this board. And next year I am gonna specifically ask not to be in this room. Sister groups. So before we had parent child, parent subsidiary, now we're talking brother sister. So this one's a little more complex. Brother sister group exists if 5 or fewer people own together 2 or more corporations. So kind of common ownership. Right? So if Madison, Trinity, and I, 5 or fewer people, the 3 of us own 3 different companies together in different percentages. Like Madison owns 30% of one company, Trinity owns 40% of that same company, and I own 5% of that company. And then we got another company that we're all owners of in certain percentages. So 5 or fewer persons, 2 or more corporations. There are 2 tests that have to be met in order for it to be a brother-sister group. And brother-sister groups, whereas parent-subsidiary groups have an advantage in that they can file that consolidated return, brother-sister groups actually, you probably don't want to be a brother-sister group. You don't want to be classified as a brother-sister group, because what it means is the IRS could come in and reallocate income and expenses between the companies. Because there's this common ownership, there could be manipulation of those income and expense items to try and maximize the tax advantages between all of the corporations. So it means that the IRS then could come in and say, nope, you're not gonna do that. This income goes over here, these expenses go over here. All right, so there are 2 tests though that the IRS uses to determine whether or not it is a brother-sister group. The first one is the ownership test. I'm gonna read through this, but it becomes a little bit more clear when we look at the table. Really, the only way to understand this is to put it in table form. I'll tell you, I'll just be honest. The first one is the total ownership test. So shareholder group owns stock representing at least 80% of the voting shares of stock, or at least 80% of the total value of all shares. Okay, so this is the total, so this is total ownership, so for each of those companies. They all 3, so Trinity and Madison and I, with these 3 companies, we own at least 80% of each of them. That's the total ownership test. And then there's the common ownership test. The shareholder group has identical ownership of more than 50% of the voting power, or more than 50% of the value of all shares. That one's a little conceptually a little bit harder to grasp. At least it is for me. All right, so the 80% test examines ownership of an individual corporation. So do they own altogether at least 80% of that corporation? 50% test is based on the smallest common percentage across all corporations evaluated. All right, so let's look at this. We've got 3 individuals and 4 corporations. This number, so what you do, you've got each of these rows is individual corporations. These totals down here, these totals here, have to equal at least 80%. Okay, so each of those has to equal at least 80%. If it doesn't equal at least 80%, then that company is not part of the brother-sister group. Okay, so this is, so we got Reed, who owns 60% of Corporation A, Smith owns 30%, Thomas owns 10%. Altogether, they own 100% of that corporation. Right? Same thing for each of these other corporations. Well, Corporation D, somebody else must own the other 10%. Right? But that's over 80%. So it meets that test. The identical ownership, what you do is you go across and you pick out the smallest number. So for Reed, his smallest percentage ownership in this group is 20%. For Smith, his smallest percentage ownership is 30%. And for Thomas, his smallest percentage ownership is 10%. Take all those percentages and add them up. If it's more than 50%, and if each of these is more than 80%, then you have a brother-sister group. So in this example, these 4 corporations and these 3 individuals form a brother-sister group. Now, if Reed owned, let's say, what do we do here? Let's say Thomas owned 10%. Then This would be 80%, okay, that still counts, it's 80, I think it's 80% or more. That would bring this down though. Now, it would still be 10, that's okay. If, let's say this amount here was not 5%. Actually, let's say Smith here. Let's say this amount was 10%. Or even 15%. Let's change that to a 15. So if this is 15%, this number becomes 85%, so it's still over 80%, right? So this corporation still is included. But once we go over across, if this is 15, then this number becomes 15, because that's the lowest number in the group, which brings this number below 50. So it is no longer a brother-sister group. Make sense? Now, it just means that corporation A wouldn't be included in that brother-sister group. These other corporations may form a brother-sister group. Okay, this is the easiest way to figure this out. Put it in a table format. Corporations up at the top, individuals on the left. Enter in their percentage ownerships. These numbers at the bottom have to be 80% or above. This number has to be above 50%. Okay? To determine whether or not it's a brother-sister group. Make sense? Sort of? Kinda? Not really? As I mentioned, so the 80% test is a vertical test. So vertical, all of these have to be 80%. At least 80%. 50% is a horizontal test, so the lowest amount across, this has to be over 50%. IRS has authority to reallocate income deductions and credits in order to prevent the evasion of taxes or clearly reflect the income of the individual corporations within the group. There is no corporate AMT anymore. There's still some AMT. This is alternative minimum tax. Alternative minimum tax was, well, it still exists for individuals, but not as many are subject to it. Essentially, it was devised to ensure that higher income individuals and businesses pay at least some tax. So you would do your taxes under the regular regime, and then you would do your taxes under this alternative minimum tax regime, and whichever was higher is what you would pay. It does not exist anymore for corporations. However, there are some carryovers that are associated with it that may still be in effect. Business interest expense limitation, we already kind of went over this. This is just this applies to every type of business, as sole props, as well as corporations and partnerships. Business interest expense, so the amount of interest expense that a business is allowed to deduct, only allowed to the extent that it does not exceed the sum of business interest income plus 30% of adjusted taxable income. So the adjusted taxable income is taxable income before business interest income or expense, before any NOL deduction, and before any deduction for depreciation, amortization, or depletion. So that's where that number comes from. Questions? So the big ones here that I want you to take away, brother-sister groups and parent-subsidiary groups.